Hi, everyone, and welcome back to another video. I'm Chris Paleologus, joined as usual by Tom Meyer Jr. And it is hard to believe that it's already halfway through the year. Feels like just yesterday we were doing our first video where we reviewed 2022 and our outlook for 2023. We've appreciated all the support and positive comments about the videos, and we're going to try to continue improving each and every month. So for today's video, we thought it would be good to do a review of what we've seen so far this year in the markets and what we expect for the remainder of the year.
Thanks, Chris. So let's start with a high-level overview of how equity and fixed income markets have been performing so far this year. We're going to put up a chart up on your screen highlighting a bunch of different indexes. The returns for the U.S. and international equity markets have been strong through the first half of the year. The broad market Russell 3000, which includes large, mid, and small cap U.S. companies, is up over 16%. The Dow Jones in value in general, which was a strong performer last year, is lagging this year versus the more growth-oriented indexes. Small caps have also lagged large caps for this year. And you'll note the S&P Small Cap 600 Total Return Index is up only 6.03% this year. International markets are up about 10%. We've seen these markets catch up in the first couple of weeks in July due to a declining dollar. Also, the international markets don't have the same level of concentration and growth orientation as the U.S. markets. Like we discussed in our last video, the U.S. market has become heavily concentrated among the largest U.S. firms, and their very strong first half performance is responsible for a large percentage of the overall market gains. So we're going to put up a tweet here kind of highlighting the enormous eight, as they're called. Obviously huge returns, and everyone else, the S&P 500 equal weight ETF, RSP, is up only 7%, and small caps, IJR, is up 6%, as we just noted. Top 10 stocks as of June 30th make up around 31.7% of the weight in the S&P 500. These companies have a much higher valuation versus the remaining 490 stocks. So we're going to put up a chart. You'll notice this is the index concentration, valuation, and earnings chart. So all the way to the left, you'll see on the green line the top 10 stocks in the S&P 500 with their PE ratios of 29.3 times, which is the current, and the remaining stocks, which is at 17.8 times, which is that gray line underneath. So clearly a big divergence here. On the top right of this, you'll see the weight of the top 10 stocks in the S&P 500. So again, as we noted, 31.7% of the S&P is these stocks. But underneath, you'll see that the earnings contribution is declining and up 21%. So what this means is their market caps are increasing while their earnings aren't contributing as much. Because of the large weight and higher valuations, they push the total S&P valuation higher. We'll put up another chart showing the S&P 500 valuation over time. Right now, the S&P 500 stands at 19.1 times next year's earnings, which puts it towards a higher 25-year average range, albeit nothing that we would consider egregious. So in the chart, you'll notice here on the green dot all the way to your right is where we are now. So again, it's 19.13 times, and the 25-year average is 16.7. So again, nothing too crazy, but clearly a little higher over the 25-year average.
Right. Yeah. And I would say in between those green lines is a pretty normal range. And then when you get outside of those green lines, either above or below, and that's when it becomes more of an outlier scenario. So that's equity markets. Now looking at fixed income markets, we'll put a chart up here that shows various fixed income maturities and sectors. So what we've seen so far largely across fixed income is returns of about 2%. For more interest rate sensitive areas of the market, like long-term U.S. treasuries, or more equity-like fixed income areas like high yield or convertible, those sector returns have been higher, albeit they do carry a higher amount of risk as well. So you can see convertibles up a little over 8.5, high yield corporates up over 5, long-term treasuries up 3.7%, and the rest of the fixed income areas hovering around 1.5 to 2%. So part of those returns have to do with what interest rates have done year to date. In this chart that we'll put up, you can see yields on the short end of the curve have moved higher as market has grappled with the Fed's continued hawkish stance. So in the top part of this chart is the actual yields of these various maturity fixed income. So 1-year treasury is about 5.3%, and obviously 10-year treasuries at the bottom around 3.8%. And then the bottom part of the chart is what those yields have done over time year to date. And this is through July 14th. So the 1 and 2 year treasury rates are higher, about 13 and 7% respectively. Longer term rates like the 7 and 10 year treasury are basically flat or even lower a little bit. So similar to stocks, interest rates move based on future expectations. We'll put up a chart here that shows that as of now, the market is pricing in rate hikes at each of the next meetings through the end of the year, at which point you can see in about January and March, they're going to be expecting a pause. And then later in 2024, the last half of 2024, the projections are for rate cuts. As with anything, these projections are subject to the information that's available at the moment. So a lot can change over the next 18 months. But this is one of the reasons that we continue to see higher short-term interest rates and lower long-term interest rates, or an inverted yield curve. And also part of the reason that we've seen growth equities perform so well this year is as the expectation for rates fall, that helps to support higher valuations in some of the growthier names and companies that Tommy discussed earlier. Another reason for the strong return so far this year has been the fact that inflation, which was a major concern last year and leading into this year, has in fact actually been coming down. So we'll put up a couple of charts here that shows CPI and core CPI year over year. You can see that CPI has fallen from its high of approximately 9% to 3% year over year. And core CPI, which excludes more volatile input prices like food and energy, has fallen to under 5%, 4.83% to be exact. So higher interest rates do appear to be working to bring down inflation, but the fear continues that the Fed will overdo it, raising interest rates too much and putting the economy into a recession, which is why we've seen continued lower long-term rates. So that's a high-level overview of what we've seen in the fixed income and equity markets year to date. So let's talk about what we expect for the remainder of the year.
So as of now, Wall Street analysts are projecting a bearish second half of 2023. This is due to a myriad of reasons, like stickier than expected inflation, particularly in the services sector, slowing earnings and GDP growth, declining manufacturing and services PMIs, and tighter credit conditions, just to name a few. It's important to note, however, that the other years they expected lower prices during the final 6 months of the year were 1999, 2019, 2020, and 2021. All the S&P 500 did those years was gain 7%, 9.8%, 21.2%, and 10.9% respectively over the final 6 months. It wouldn't be surprising to see the market finish moderately higher, flat, or slightly down from these levels. The VIX, or the volatility index, which is a rough measure of the market's expectations for volatility over the next 30 days, is close to the low for the year and is down more than 38% year to date, which could point to a level of complacency in the market. Additionally, if we see earnings growth slow or expectations decline surrounding AI, which has pushed many of the top companies higher this year that we highlighted earlier in the video, those companies could begin to become a drag on the overall market returns.
Exactly. So how does this relate to how we're thinking about clients' portfolios? We continue to maintain diversified portfolios that will benefit from a variety of market outcomes. For example, while we were still optimistic about value going into this year, and we still are optimistic, that diversified approach proved to be beneficial as growth-oriented investments outperformed this year. So not going all in on one style or sector has really proven to be beneficial. We've been adding to investments that pay out above average dividends to benefit from moderately higher and flat markets. Those investments should also perform better in down markets due to a higher yield offsetting some of the market declines. Investments like buffered ETFs have helped many of our clients stay invested during periods of uncertainty like last year, while allowing them to participate in most of the gains that we've seen so far this year. For fixed income, we've been shorter duration, so owning shorter maturity bonds due to their higher yields and all the interest rate uncertainty that's in the market. We have been starting to extend duration or or the maturities of those bonds of some of our fixed income to lock in today's higher rates, which would benefit from flat or lower interest rates in the future. Of course, all of this is in context to what our clients' risk tolerance, goals, and long-term objectives are. Volatility is a normal part of a functioning market, and we do expect to see higher volatility at points over the next 6 to 12 months. As I put this chart up, I would bet, in fact, that many of you have forgotten that the market actually had a decline of almost 8% this year from peak to trough. Those types of market declines are a feature and not a bug of healthy markets, and happen more often than you might expect. So this is one of our favorite charts that just illustrates, on average, basically an 8.7% return over, from 1980 through today. But all the various, peak to trough drawdowns that we've seen over the course of those years. So you have to withstand some volatility to participate in those gains.
So we'll finish with a chart we used last year to show the benefits of thinking longer term about your investments. This shows the worst 6-month period for the Wilshire 5000, which is a broad US equity index going back to 1971, and its subsequent returns over the various time periods moving forward. And as you can see, the returns over all the listed time periods tend to be positive, but the further out you move, the larger the returns get. So we'll just take a look here and go for rank number 11, which is highlighted in blue, which is the starting month of January 22 and the end month of June 2022. You'll note that the 3-month total return is down 20.9%. But again, as you go out, we're already, for the forward total returns of 1 year, up 19% since then. Seeing this information along with your financial roadmap, we hope that you feel more confident during periods of market volatility about being able to reach your financial goals and objectives. Of course, if you have any questions, please feel free to reach out to your portfolio manager. And as always, we appreciate you watching, and don't forget to like and subscribe. Thanks, everyone.
Thank you.